Welcome to the Deep Dive. We are jumping right into what was, I think, one of the most polarizing earnings calls of the season.
Oh, definitely. We're talking about the Alibaba Group fiscal Q2 2026 results. They dropped pre-market on November 25th.
And our mission today is really to cut through all that noise because there was so much volatility, so many conflicting headlines.
Exactly. We need to understand the really brutal strategic trade-offs that management is making here.
Right.
They're basically setting fire to their short-term profits and cash flow, all to secure long-term dominance in, well, two areas they see as non-negotiable: AI and quick commerce.
And that tension is the whole story, the deliberate pain now for hopefully a big gain later. You had these great top-line revenue numbers.
A clear beat.
And then they just crash headfirst into what you can only call a catastrophic collapse in profitability.
Yeah, the market was genuinely confused. It popped pre-market and then sold off hard during the day.
Okay, so let's get into the numbers. That top-line success, what did it look like?
So revenue came in at RMB 247.8 billion. That's about 34.8 billion US dollars.
Yeah.
And it easily beat what the street was expecting.
And I think what's interesting is the underlying momentum was even better, right?
That's the key. The headline growth was only 5% year over year.
Yeah.
But management was quick to point out, once you strip out some recent disposals, they sold off SunArt and Intop.
Right, non-core assets.
Exactly. The organic underlying growth was a much healthier 15% year over year. So the core is strong.
The core is strong, but I mean, that strength was just completely wiped out by the profitability numbers. This is where the investment strategy just slams into the income statement.
Slams is the right word. I mean, non-GAAP adjusted EPS, that's the number most analysts watch. It was only 61 cents per ADS. That's a 71% drop year over year.
71%. And it missed consensus too.
By a lot, almost 8%. That's a huge gap between what was expected and what they delivered on the bottom line.
And the deeper you go, the more dramatic it gets, right?
Oh, yeah. You look at GAAP net income, it plummeted 53%. But the most revealing number, the one that really signals the intensity of this whole strategy shift, has to be adjusted EBITDA.
Okay, what was that?
A 78% decrease year over year.
Wow.
I mean, it's just a shocking number. When you see a metric like that fall off a cliff, you know the company isn't just tweaking things. They're consciously tearing down their old financial model to build something new.
It's like the income statement is just screaming, we are spending money right now.
And it wasn't just on the income statement. This wasn't just paper profit. It hit their cash reserves hard.
So the pain moved directly into the cash flow.
Precisely. Operating cash flow plunged 68%. And the big one, free cash flow, or FCF, it turned deeply negative.
And FCF is the real cash, right? The money left after all the bills and investments are paid.
It's the ultimate measure of financial flexibility. They had a massive RMB 21.8 billion outflow. To go from a healthy inflow last year to a huge outflow this year, it just shows they are actively burning cash to fund this next phase.
And that's what really spooked the market, wasn't it, that FCF number?
Absolutely. It shows the immediate real-world cost of this strategy. So the stock, it initially popped maybe 3% on the revenue beat and the flashy AI headlines.
But then reality set in.
As investors digested that margin collapse and the negative FCF, it reversed, closed down 2.3% on heavy volume. It's the market saying, we hear your story, but we are very nervous about the timeline and the cost.
Okay, so let's unpack that story. The strategic narrative. CEO Eddie Wu was pretty explicit. He called Q2 a growth investment quarter.
He did. He stressed this is intentional. Self-inflicted pain. It's the cost of admission to the future, not some structural weakness in their core business.
And this cost falls into two huge buckets. The first one is AI and cloud intelligence.
This is probably the most important one for the long term. The Cloud Intelligence Group revenue grew 34% year over year.
Which is solid, but what's driving that?
Well, this is what's so fascinating. The AI-related products inside that division delivered triple-digit year-over-year growth.
Triple-digit?
And for the 9th consecutive quarter. This is not a one-off. It's a sustained compounding acceleration.
Okay, the next part, when I was reading through the call notes, this is what really jumped out at me. The big tell.
I think I know what you're going to say.
Management said they are not demand constrained. They are capacity constrained on AI servers. They literally cannot build data centers fast enough to meet demand.
That is the crucial validation. It means the demand is real. It's overwhelming even. The bottleneck is physical hardware. And to fix that, they confirmed a commitment of at least 380 billion RMB.
Which is what, 53 billion US dollars?
$53 billion in AI and cloud capex over the next 3 years.
That is just a staggering amount of money. I mean, that's the GDP of a small country. Isn't that a massive risk, committing that much based on today's demand?
It is, and that's the billion-dollar question. But they basically said, given what they're seeing, that 380 billion figure might actually be an underestimation.
So they might spend even more.
They might have to.
Yeah.
The risk they're taking is the price they have to pay to become the default AI infrastructure provider in China. They're betting that scale and speed will create a moat no one else can cross.
And they're building the ecosystem around it too, right? With the Quen language model.
Exactly. The Quen app crossed 10 million downloads in its first week.
Wow.
Which shows you it's not just enterprise demand. They're getting consumer traction, which lets them plug AI into their whole e-commerce and lifestyle universe. It's a full stack play that, in their minds, justifies the spend.
Okay, let's pivot. The second pillar of all this spending, quick commerce and instant retail. This is the ground war against rivals like Meituan.
It is. And the growth numbers here are also huge. Quick commerce revenues surged 60% year over year. The whole China e-commerce group was up a respectable 16%.
But the real story there isn't just revenue, it's about making the math work, the unit economics.
And that was a huge positive buried in all the bad news. Management reported that the per-order losses in quick commerce, they've been cut by 50% just since the middle of 2025.
In just a few months, that's a huge efficiency gain.
It's a key indicator that their heavy spending on logistics and optimization is starting to work.
And they're changing the product mix too. I saw that non-beverage orders are now over 75% of the total.
Which is critical. You're moving from delivering a low-margin can of soda to delivering higher-margin groceries and specialty goods. It completely changes the economics of each trip.
So to justify all this cash burn, what's the big goal here?
They set a huge one. They're targeting 1 trillion RMB in annualized GMV, that's gross merchandise value in instant retail, over the next 3 years.
1 trillion, if they hit that, it changes everything.
It validates the entire strategy.
Right.
And they're using their biggest weapon to get there, their existing Tmall brands. Over 3,500 of them have already put their physical stores onto the quick commerce platform.
That's the synergy, using the empire they already built to fuel the new one.
So if we look forward, what does this all mean for an investor? Management was clear. FY26 margins are going to stay under pressure, but that mid-teens revenue growth is sustainable.
And they did offer a little bit of a light at the end of the tunnel, didn't they?
They did. This is crucial guidance. They believe the September quarter, the one they just reported, was likely the highest point of investment scale.
The peak burn rate.
The peak burn.
Yeah.
Because those unit economics are improving, they expect the scale of the investment to size down to moderate by next quarter.
But the market's reaction, that 2.3% drop, shows investors aren't buying it yet. Or at least they're skeptical.
They're unconvinced about the timeline. There's a big risk premium being applied here. Alibaba has this tough dual challenge, right? They're fighting a price war in their core e-commerce business.
While also spending tens of billions to catch up in the AI arms race.
Exactly. And you have to remember, the stock had a huge run-up over the last 12 months. This is a bit of a reality check. The market is asking, is the reward really worth this level of spending?
Which brings us to our final segment. We've covered the numbers, the strategy, now for ideas. And we have to say it, this is for entertainment and discussion only.
Absolutely. This is not investment advice. Please talk to a professional.
Okay, disclaimer done. Let's talk about the core conflict here and how you might build a trade around it.
The core fear is that the 380 billion RMB capex plan isn't enough, that it underestimates the need. And that, combined with the horrible negative free cash flow, well, the market sold off on that fear, the fear of an endless cash burn.
So you need a trade that plays on that immediate fear, but also on the potential for massive long-term success.
Right. So we came up with what we're calling an outrageous but plausible conceptual trade. The structure is basically bearish in the near term on the cash burn, but powerfully bullish long-term on the idea of infrastructure scarcity.
Okay, walk us through that. How do you do it?
Well, you basically bet against management's hopeful short-term commentary. You could sell short-term bearish options like puts that target the next earnings report in February 2026.
So you're betting the stock stays weak or goes lower in the next few months.
You're betting that the fear of the cash burn continues to weigh on the stock. That generates some income right away and plays on that high volatility.
Okay, that's the bearish near-term part. What about the long-term hope?
At the same time, you'd use that income and more to buy deep, long-term calls. Push the expiration way out to 2027. This is the bet on the core insight that they are capacity constrained, not demand constrained.
You're betting that once they build out that $53 billion of infrastructure, and once quick commerce hits that 1 trillion GMV target, the profits and cash flow will come roaring back.
Exactly. You're betting that the market re-rates the entire company. You're treating it less like an e-commerce stock and more like a discounted long-term infrastructure play that's just under temporary supply pressure. It's a trade designed to profit from the gap between investment and monetization.
So to wrap it all up, this earnings call was a really clear signal. Alibaba is all in on a high-risk, capital-intensive path. They're accepting this margin trough to secure their future as what they hope will be China's default AI and commerce utility.
And the big question is just, will the speed of monetization catch up to the speed of the cash burn?
Right.
And that leads us to our final provocative thought for you to chew on. Management imply this isn't just an Alibaba problem. They imply that demand for AI infrastructure is outstripping the global supply of components.
So it's worldwide scarcity.
Potentially. And if that's true, does it mean the AI bubble skeptics are just wrong? That we're actually entering a long-term resource scarcity scenario that will massively benefit the few companies, like Alibaba, that are willing and able to spend $50 billion or more upfront to secure the hardware.
That reframes it completely. From a risky spending spree to a necessary land grab for resources. We'll leave you to think about that one. Thanks for diving deep with us.